Hey, good afternoon and welcome back, everyone. My name is Tony Zhang. Today, we're going to be talking about how to maximize your income using credit spreads. So thank you very much for those of you that are back here during our options education webinar series. A pretty special webinar for you guys here today. This is a slightly more advanced strategy for those of you that like to sell credit spreads or like to learn about how to sell credit spreads. Very flexible strategy to allow you to take a directional view on any given stock or ETF. The great thing about credit spreads is that they're quite forgiving. They are generally high probability trades, which a lot of you like, but there are some caveats to that. So I want to make sure that we really dive into, what a credit spread is, how to construct it, go through the best practices, and then lastly, show you guys some real examples so that you can actually take home some ideas as to how to deploy this with options play. So welcome back for those of you that have seen some of our webinars before. For those of you that are your first time trading options or first time looking at options play, really welcome. This webinar is pre-recorded or recorded rather, so that you will be able to see the recording afterwards. I will also send the slides for you so that you can follow along at any time after we're done. But the goal here today is to really make sure that you guys understand credit spreads, know how to deploy them properly, and then more importantly, you know how to utilize options play, the software that's free of charge to you through the TMX, so that you can be self-sufficient in being able to construct your own credit spreads and be able to start evaluating them for your trading. So that's really what I hope to help you guys learn here today. My name is Tony Zhang. For those of you that are unfamiliar with who I am the chief strategist here at Options Play. I'll be walking you guys through the slides. I'll be giving you some examples using Options Play, and let's go ahead and get started. Now, in those slides that I'll be sending you with the recording, there's some important links. So for those of you that are brand new to options play and you want to explore other forms of trading and you want to see some of our pre-recorded webinars, or if you just want a brief introduction to options play, there's going to be a link here for webinar recordings. I highly recommend for those of you to take a look at those recordings if you want to look at some other subjects. Free access to Options Play Canada, like I said before. I'll include a link to this in the last slide as well. So especially if you're a Canadian resident, please take a look at Options Play Canada, because the TMX is paying for your access. So you can have access to all the things that we're showing you here today free of charge. For those of you that like to trade US stocks, I also have a link here to show you how to get access to the US version of Options Play. And then lastly, start your subscription on the US side for those of you that are interested in that. So just to get some of the housekeeping out of the way, today we're going to be talking about, number one, what are credit spreads? For those of you that are brand new to this strategy, this is a slightly more advanced strategy, which does require you to have some basic knowledge of options. If you're brand new, we will break down what they are to help you better understand each one of these strategies. But if you've never traded an option before, you may want to start with an easier strategy. But this is one of the more forgiving strategies when it comes to trading options. So this is one of the ones that you do want to take some time and learn about. We'll talk a little bit about when is the proper time to utilize credit spreads, because they're not useful for all market conditions. They're only useful in certain market conditions, so really important to understand when those are. More importantly, how do you trade them effectively? And lastly, credit spread strategy management. That's really what I want to spend some time understanding is, what are the optimal credit spreads to use? How do you manage them once you're in that trade? These are some of the things that I want to go over. And lastly, we want to spend the most amount of time using some live analysis, so some real symbols, some stocks and ETFs, some examples that I have for you to show you how you can take a directional view using options play, and more importantly, how can you instantly structure that into a credit spread, evaluate it properly so that you can decide whether it's suitable for you. Now, before I move on, I just want to launch a quick poll here. You should see one on your screen right now. I just want to get an idea as far as the trading experience here of the audience. How many of you have traded credit spreads? How many of you have traded other option strategies? And how many have never traded an option before? Okay, so it looks like it's a fairly even split between those of you that have traded credit spreads and have traded other option strategies, but about 20% of you have never traded options before. Okay, great. So here are the results. 32% that have traded credit spreads, 48 that have not traded credit spreads but have traded other option strategies. So if you've traded other option strategies, this will be an interesting one to learn about. And then for those of you that have never traded an option before, I really hope that this inspires you to take a look at options. As you can see, the different use cases of credit spreads, that if you're just a stock trader, you may not even be able to trade at all. Meaning sometimes you might be looking at a chart, have an idea, but you can't leverage that view using stocks. You might be able to find an alternative here using options. So this is really what I'm hoping to share with you guys here today. So let me close this out. So today we're going to be talking about what are credit spreads. Number one, there's two types of credit spreads that you can trade: bullish credit spreads, which is the bull put spread, or you can trade bearish credit spreads, or what we call a bear call spread. So what do these two mean? How do we break them down? That's what we're going to talk about here. So first of all, one of the first things to remember about any credit spread or any debit or credit spread, the reason that we like trading them for all of our directional views is because of the fact that they have limited risk and limited reward. What that means is that we know exactly what the potential best case and worst case outcomes are for all of our trades. This makes planning trades a lot easier. This makes allowing you to stick to your original plan also a little bit easier, because you've already planned for the worst and best case scenarios. So nothing comes as a surprise to you once you're in the trade. Having limited rewards gives you this flexibility of knowing exactly what can potentially happen ahead of time. And I generally find that when we're trading, the hardest thing to manage sometimes is our emotions. So by allowing us to pre-plan our trades ahead of time, it allows us to better manage our emotions once we're in our trades, because we know how much money we can lose. So when we're down that amount of money, we're not saying, oh crap, what do we do? So this is really one of the key benefits of trading some of these directional strategies using credit spreads. Now, to break down what a credit spread is, I'm going to use a fictitious stock XYZ trading at $100. I usually hate using these fictitious stocks because it really becomes difficult to bridge that theoretical academic view of learning options with your practical sense. But from the purpose of helping you understand how to construct one of these, some of these fictitious examples sometimes are easier to work with. And then I will make sure that we jump over to some real stocks so that you guys have something tangible to hold on to as you go through your learning process. So in this first example, I have stock XYZ trading at $100. In this particular case, I'm bullish on this stock. I'm bullish and I think it's going to move higher. So I can sell a credit spread to try to make money on this. So we're going to come back to how bullish I am on this particular stock in order to sell this. But first, we're just going to talk about I'm bullish. I think it can move up $1, $3, $10. Doesn't matter. I'm bullish on this stock. So what we would do is you'd sell what's called a short put vertical in this particular case. That's the credit spread that you can sell that allows you to take a bullish view on this given stock. So to construct a short put vertical, what we're going to do is we're going to sell a $100 put, so an at-the-money put on the stock, which in itself is a bullish strategy. And let's say we collect $4 in premium to sell that put. But because selling a put has unlimited risk, and we don't want to take on a substantial amount of risk when we're doing these types of trades, what we're going to do is we're going to buy a $90 put against that $100 put that we've sold. And let's say that costs us $1 to buy that $90 put. What that brings us is a net credit of $3 to enter the trade. And that is going to be your max reward. Your max reward on a credit spread is the credit that you receive. That's part of why we call it a credit spread. Your max risk is determined by the distance between the two strikes. So the $100 put minus the $90 put is a $10 width. The distance between those two strikes minus the $3 credit that you receive. So your max risk here is $7. Now, that initially when a lot of people look at that say that doesn't quite make sense. Why would I risk $7 to make $3? I'll show you in a little bit in the next slide as to why that is the case. And this strategy will actually be profitable as long as stock XYZ stays above $97 at expiration, which is a little different than most other strategies because we said we're bullish on stocks XYZ. Yet if the stock goes down to $97, we can still at least break even on this trade, which means that if the stock stays at 100, if it goes up to 103, if it goes up to 110, or even if it goes down to 98, we're still going to make money. That's one of the benefits of trading this strategy. And that's really why we have this negative risk to reward, is because it can be profitable in a lot of different scenarios. Even if the stock doesn't go higher, that can't be said for any other strategy. So that's an interesting aspect of a credit spread. Next, I want to look at the bearish side of the same trade. So same as stocks XYZ at $100, but this time I'm bearish on the trade. How can I trade that? Same thing, what we're going to do is we're going to start by selling a $100 call, an at-the-money call. Let's say I collect $4 on that trade. But because selling a naked call has unlimited risk and I don't want to take that, what I'm going to do is I'm going to buy a 110 call against that. And let's say it costs me $1. And what that does is it caps my risk to the downside. And same thing, because I've collected $4 on the short leg, I paid $1 on the long leg, my net credit is $3. So again, my max reward here is $3 because that's the credit I received. And my max risk is, again, the distance between the two strikes, between the 100 and 110 call, that's $10, minus the max reward. So my max risk here is $7. So you can always think of the full opportunity as the distance between the two strikes. Your max reward is what you collect, and your max risk is the remaining piece of that opportunity. And this strategy will actually be profitable as long as stock XYZ trades below $103 at expiration. So even though I'm bearish on stock XYZ, even if the stock goes up, I can still make money on this strategy. That is really one of the key things about credit spreads. As long as the stock moves down, stays neutral, or even moves slightly higher, I can still make money on these types of strategies. So it's very forgiving in terms of your directional view. And that's what we mean when we say it's very forgiving. So let's take a look at, let's now dive into the credit spread. Now that we learned how to construct them, let's take a look at how they perform. So number one, one of the things that we should think about when we're selling credit spreads is that generally speaking, ETFs and index options tend to be a little better for credit spreads than individual stocks. And the reason for this is really because when we're selling credit spreads on ETFs and index options, those ETFs and index options don't have a lot of big moves. Credit spreads is not a strategy that you want big moves for. Credit spreads is a strategy that you want the stock to remain fairly neutral. You want it to be less volatile. So that's why ETFs and indices tend to be less volatile than individual stocks, which is why, generally speaking, people tend to trade them more on ETFs and index options. That does not mean that you can't trade credit spreads on individual stocks. It just means that they tend to perform a little better on ETFs and index options. Next, when it comes to picking expiration dates, generally speaking, credit spreads are sold in relatively shorter dated options. And the reason for this is because a credit spread is effectively net short. So short dated options allow you to maximize your theta or your time decay. So this is really why we want to use shorter dated options for credit spreads versus longer dated options. When it comes to the strike price, this is really where you have a lot of flexibility as to how you choose your strike prices. I will, in a few slides, show you kind of what, based on our back testing, what we feel are the optimal strikes. But I want to give you guys a feel for the range of strikes that you can choose when it comes to credit spreads, because there's a lot of flexibility here. And it's really important to understand the difference between the different strikes that you can choose. So first of all, you always want to sell out of the money credits. You're always dealing with strikes that are out of the money, generally speaking, when you're selling credit spreads. But you can sell strikes that are relatively closer to the current price. And these are characterized by strategies that have generally lower probability of profit, but better risk to reward. Or you can sell really far out of the money credit spreads, and these are characterized by much higher probability of profits, but they are traded off by really worse risk to rewards. So it's really important to understand this relationship when you're picking your strikes and your strike prices. So that's why I put up here the next slides to give you an idea as far as really the true relationship between risk to reward and probability. Because no matter what type of options trading you do, whether you're trading long calls or puts, or selling cover calls, or selling credit spreads, the relationship between probability and risk reward remains the same. So it's a really important concept to understand, even if you're not selling credit spreads. So with all options trading, you're trading off probability with risk reward. And the reason that I wanted to show you guys this is because I see a lot of users come to me and ask me questions about just probability. They're always asking me, how do I find high probability trades? How do I, why would I trade something with low probability? And my answer to them is always that if you're only looking at probability, you're only seeing half the picture. You have to look at both risk reward and probability to get an idea as far as what you're trading. So when you're selling near the money strikes, and I'll show you what that looks like with some real examples later, they generally tend to have probability of profit that are in the range of 60 to 70% winners, with about 30 or 2/3 winners versus 1/3 losers. And these are characterized by trades that have roughly a risk reward of about 2 to 1, meaning you're risking roughly 2 times the amount the premium that I'm collecting, or the credit that I'm collecting. So for every $100 I'm collecting in premium, I'm roughly risking about $200 to trade that. These are the types of probabilities and risk rewards that you'll see when you're selling strikes that are close to the current price. So the example I just gave you before in stock XYZ, these are typically the type of risk rewards that you'll see. Now, I do see a lot of credit spread traders tend to favor trading these really far out of the money credit spreads. And I believe it's because people want to target credit risk reward ratios or probability of profits of very high probability of profits. That sounds very good on paper, that I have a strategy that wins 90% of the time or 95% of the time. I've even seen strategies that trade with 98% probability of profit. But again, if you only focus on this probability side of things, you're completely missing the other half of the picture. So when you see these really high probability trades, and there's plenty of examples, and I'll show you a few in a few seconds, they are traded off by extremely bad risk reward ratio, meaning you might be collecting $100 and have a 90% chance of keeping that $100, but that 10% of the chance that you have a loser, you might be risking $900. Actually, most of the time I see these trades, the risk is actually far worse. A lot of times when you're trying to collect $100 with a 90% probability of profit, many times you're risking almost $2,000 on the back of that. And you have to make sure you're aware of that risk. So you can collect $100 9 times in a row, but if that 10th trade loses $1,900 instead, you're now down net $1,000. That's not a position you want to be in. So that's really why it's important to pay attention to both sides of the picture before you trade a credit spread. And I'll go through some examples in a few minutes with some real stocks to really help illustrate this process. So now that we've talked about what a credit spread is, really understanding the relationship between probability and risk reward and helping select your strikes, I want to provide some guidance as to what we found when we back tested these types of strategies. And it was very clear when we tested these credit spreads what are the optimal strike prices with respect to the current price. So we generally find that the lower probability of profit credit spreads are far better for you in the long run than those really high probability, really poor risk reward trades. And it really comes down to those few losers that you have offsetting tens of or hundreds of trades in a row that really wipes out the gains from having really high probability of profit. So what we found is, generally speaking, it's best to sell a roughly at the money call or a put, so a 50 delta call or a put to start as the sell leg, and the buy leg is roughly about a 25 delta, about a little further out of the money call or a put against that. These are the two deltas that we find construct an optimal credit spread. And for those of you that are not familiar with deltas, or maybe are not looking at an option chain, another way that we've noticed that the characteristic of the optimal credit spread is that the credit that you receive on a credit spread should be roughly 1/3 the distance between the two strikes. So if the strike distance is $3, you should roughly collect about $1. If the distance between the two strikes is $5, you want to collect roughly $1.67, and so on and so on. So if you have a $10 strike width, you want to collect roughly $3.33. If you stick to that rule, you'll be roughly in this camp of selling an at-the-money call and buying back roughly a 25 delta call. And these are, again, characterized by exactly about a 2-to-1 risk-to-reward ratio, because that's how we collect 1/3 the distance of the strike. And they generally have winning ratios about 60 to 70%. This is what we see as the optimal credit spread based on all of the back tests that we've done, trying all different expiration dates and strike prices. This is what we generally found. So now that we talked about what are the optimal credit spreads, now I want to address when do we actually trade these, okay? And this is really important because we talked about, credit spreads are very forgiving. They can be profitable in a lot of different scenarios, but they're also suboptimal in a lot of other scenarios. So it's really important to understand when to use them. And the first and foremost, you want to use credit spreads when you have a neutral or modest move, or when you're expecting a neutral or modest move in an underlying stock or ETF. What this means is that you don't have a strong directional view. You don't think the stock's going to take off and jump 10 points in the next 2 days. You think that the stock is going to stay somewhat sideways or mildly bullish or mildly bearish. These are the optimal times to use a credit spread. So for those of you that like to use overbought or oversold technical indicators like RSI, MACD, stochastics, any of these types of momentum indicators that give you a sense of overbought and oversold, those are ideal technical indicators to give you buy and sell signals for credit spreads. And I'll talk a little bit about that in a few minutes. Double tops or bottoms. So for those of you that like to use charts and you feel that you found a support level where you think the stock's not going to continue going any lower, that's a good time to sell a put credit spread when you feel that it's at a bottom and it's bottoming out. And I have a few examples of this in some of the financial stocks up in Canada that are exhibiting this double bottom, and they're kind of oversold. These are ideal for selling credit spreads, and vice versa. If something is overbought, and you're bearish on something, you want to sell a call credit spread. And the last thing to remember here, credit spreads, do not use them when you expect a large move, because there are much better strategies to trade if you're expecting a large move. Credit spreads are not going to allow you to really take advantage of the large directional move. And I'll show you some examples of that to really illustrate that, why credit spreads is only useful for when you expect a modest or neutral move. So next, what I have is just a chart, and I really want to kind of illustrate the difference between when we're expecting a large move versus when we're expecting a small, modest directional move. So here I have a chart of a stock that traded between a pretty wide range between 103 and 95 for quite some time, and started to form this triangle, this kind of indecision. These are generally the types of price action that we're looking for, where when it breaks out of a level, we're expecting a quick, fast move in one direction. So this is the opposite of when you want to use a credit spread. If you think that a stock is going to make a quick, fast move, you generally want to use debit spreads, because they will take advantage of a much larger move in the underlying stock. Conversely, when you have a stock that's trading within a range and it's not moving a lot, and you don't expect a large move in one direction or another, this is when you can start using your technical indicators. So whenever it's overbought, oversold, you want to sell a put credit spread. When it reaches overbought, you want to sell a call credit spread. And when it reaches oversold again, you sell another put credit spread. And you can do this over and over again. So as you can see, the characteristics of a credit spread trader is that you tend to trade credit spreads on the same symbol over and over again, like such as this example here. I can sell the credit spread 1, 2, 3, 4 times on the put side and 3 times on the call side. So that's a total of 7 trades in a fairly short amount of period on the same symbol here. Conversely, on a debit spread, out of this entire chart, I probably have maybe 1 or 2 opportunities. When this stock broke above this 103 resistance level, because I didn't know it was going to fall back down, maybe I thought this was going to break out higher and move substantially higher again. So that would have potentially been an opportunity to buy a debit spread, which I would have lost money on because that move never materialized. But in my opinion, looking at this whole chart, those are the only 2 opportunities where I could have thought that there could have been a big move. So debit spread traders tend to trade less frequently on the same symbol. They tend to constantly look for new symbols to trade, versus credit spread traders tend to focus on one symbol and trade them over and over again. So these are all things to consider when you're looking at these types of these strategies, to think about. These are the things that credit spread traders typically look for. So now that we've talked about when to trade credit spreads, let's talk about how to manage them effectively. This is really, really important once you're in a credit spread. Now that you've learned how to construct them, when to get in, what are the optimal ways to construct them, let's take a look at how to manage these trades. So number one, how to enter these trades. You want to enter them with the top or bottom, or oversold or overbought. Any of these type of examples are optimal times to enter a credit spread. You can string calls and put verticals together, meaning in this particular case, you could have sold a call credit spread here and 5 days later sold a put credit spread, even when the call credit spread hasn't expired yet. You can actually string them together. A lot of times you might end up selling a put credit spread on the exact same expiration that you sold that call credit spread just a few days ago. These are all opportunities to sell credit spreads, and you don't have to wait for one to expire before you trade the other one. Now, when it comes to once you're in that trade, how do you manage them? This is where it gets a little bit more involved than some of the other strategies, and it really depends on what type of credit spreads you sell. But number one, the goal for credit spreads is to simply let them expire worthless. Very similar to like a cover call or a short put. When you sell them, you want them to expire worthless so that you keep the whole credit. It's the same concept with credit spreads. Now, when should you consider cutting your losses on a credit spread? That's really where it depends on what type of credit spread that you're selling. So we talked about that we want to collect roughly a third of the width of the credit spread. So if your premium that you're collecting is greater than 20% of the vertical width, then you want to cut your losses when you've reached anywhere from 75 to 100% loss on the credit spread. That's usually a good rule of thumb of when to cut your losses on a credit spread. Now, for those of you that sell those really far out of the money credit spreads that have very high probability of profits, this is where the premium you're collecting is going to be less than 20% of the vertical width. So if you're selling a credit spread that's $10 wide and you're only collecting $1, that's an example of where you're collecting less than 20% of the vertical width. And this is where you want to cut your losses if you've lost anywhere from 100 to 200% of the credit that you've received on that trade. So your exit strategy on a credit spread depends on how much premium you're collecting. The smaller the premium you're collecting, the larger room that you have to give for that stop loss in order for you to trigger that stop loss. The larger the premium you receive, the less that threshold is. So it's a little trickier because you have to decide, am I trading high probability credit spread or low probability credit spreads? And from that, determine what your exit strategy is. So it's a little bit more involved. And this is why I say this is a slightly more advanced strategy. But for those of you that are trading credit spreads or interested in trading credit spreads, make sure you pay attention to this slide before you start trading them. So let's now jump over to options play. I want to show you guys some examples of some stocks, or ETFs rather, that you can potentially look at deploying a credit spread on. So I want to bring up BMO first, because this is probably a stock that many of you follow. The financials is heavily traded in Canada. And before I jump into an actual example of constructing a debit spread, or a credit spread rather, I just want to do a quick overview of options play for those of you that have never seen this before. This is a tool, again, that's available to everyone free of charge in Canada. So I'll send the link on how to register for this if you don't have it after the webinar. But the platform itself is divided into 3 sections. We have trade ideas and watch lists here on the left-hand section. In the middle is our security analysis panel, and trading and income here is on the right. We call these 3 panels the what, the why, and the how. Because when you look at a trading platform every morning, you want to say, what symbols should I pay attention to? We have fresh, bullish, and bearish ideas for you, scanned for you every single day. You have watch lists so that you can keep tabs on the stocks that you want to pay attention to, and we even have pre-built watch lists for you with some popular Canadian stocks, so you can quickly take a look at what's going on with the big names in Canada. Or you can type in any of your own symbols and populate this middle panel, the security analysis panel, that gives you an idea as far as what's currently going on with each stock. So we have a 1 month and 6 month trend indicator that gives you an idea as far as short-term and long-term trends. We have a technical score, which is a relative strength indicator to give you an idea as far as how strong a stock is compared to the overall market. And lastly, earnings, dividends, and price action data here at the bottom to show you how relevant information that you need in order to place that trade. And once you have that directional view, once you're either bullish or bearish on an underlying stock, we will present to you 3 starting points to take either a bullish view or 3 starting points for a bearish view. So right now, what I'm going to do is I'm looking at BMO here. And the only reason I'm looking at it is because I'm trying to be a bit of a contrarian here. It's a relatively stable industry in terms of Canadian banks that have, in my opinion, fairly stable profits. But it's taken a huge beating over the last month or so. So I do think that perhaps it's a little bit oversold. It certainly is near this support level. And as you can see, the momentum indicators have been near this oversold territory for quite some time. So I think there's a possibility of a bounce a little higher. I don't know how much higher it can go. I don't think it can go much higher beyond 101, 102, but I certainly think that I have a mildly bullish view here on generally speaking Canadian financials here, and I do think that it's a bit oversold. So what I want to do is I want to compare a few different strategies. I want to compare buying a call to buying a debit spread, which is what you would traditionally use if you were bullish on a stock. And now what I'm going to do is I'm going to change this stock position. I'm going to change this to a credit spread. So let's do a November 30th, which is a relatively short dated option that expires in about 3.5 weeks. I'm going to sell an at-the-money call or put against that. So I'm going to sell a $99 put. I'm going to buy a $97 put against that. And as you can see, I'm going to collect $55. So this is a little greater than a fourth of the width. So not exactly the spread that I'm looking for, but maybe, okay, let's do this. I can sell the 99.5, 97.5, which is a $2 wide spread. I'm going to collect 65 cents on that. So that's almost exactly a third of the width. That's exactly what I'm looking for. So this is one of the other ways that you can find the optimal strikes without having to necessarily fiddle around with different deltas, is just select a width and move the strikes up or down one until you collect roughly a third of the width. So the width here is $2 between 99.5 and 97.5. And for a $2 width, I'm looking to collect roughly 67 cents. So I'm getting 65 cents here, which is right pretty much on target. So now what I'm going to do is I'm going to compare that to buying a call and buying a call vertical, which is traditionally what you would do if you're bullish on a stock. Now, in order to compare these 3 strategies apples to apples, what I'm going to do is I'm going to say I want to risk, let's say, $2,000 or maybe $1,000 on this trade. Just so I'm comparing everything apples to apples. As you can see here, now my max risk here is roughly about $1,000. Let's do a little more than $1,000. Let's do $1,200. Okay, let's do $1,200. So now I have roughly about $1,000 risk across the 3, so they're very similar. So here I can sell 8 contracts of the call, the credit spread. I can buy 3 contracts of the call or 4 contracts of the debit spread. Each one of these giving me roughly about $1,100 worth of risk. And now I want to compare these 3 strategies depending on where I think BMO is going to go. So BMO is at 99.45. Let's say I think it's going to stay exactly where it is by expiration. So if expiration, on November 30th, the stock is at 99.40. Let's do November 30th, which is probably what we want to be looking at. So November 30th, which is our expiration date. If the stock stays exactly at 99.40, I'm going to make a $440 profit on the credit spread, but I'm actually going to lose $300 on the call or lose $318 on the call vertical or the debit spread. So as you can see, if I think the stock's just going to stay neutral, number one, I'm actually going to lose money from each of these 2 strategies. Or if I bought the stock, I'd basically be breaking even. So this is really where, again, credit spreads allow you to take advantage and actually profit from a stock going absolutely nowhere, something that you can't do from any other strategy. And that's really the benefit and the flexibility that credit spreads provide you. Now, let's say, I said before, but I do think that it can maybe move up to 101, 102 modestly. So let's take a look at what that looks like. The stock goes up to 101, so it moves a couple of dollars higher, mildly higher. And this is one of the things that I want to point out is that when you get one of these kind of buy signals from one of these momentum indicators like stochastics that I have here, the momentum indicator doesn't give you any sense for how far the stock's going to move if it does on a buy signal. So that's one of the things to remember, is that just because you get a buy signal is not necessarily a good reason to go buy that call or buy that call spread or even buy the stock, because the signal doesn't necessarily mean that the stock is going to move higher. It just means that it's unlikely going to move any lower. And that's why it's one of the ideal signals to use with selling credit spreads, because the stock doesn't need to move much. You can still make profit. Conversely, if the stock does go to 101, if I bought the call, I make a $37 profit. If I bought the call spread, I make a $50 profit. So both of these two strategies, not ideal considering if the stock moves $1.50 higher. So now let's take a look at what happens when it goes to 102, which is that resistance level that I see here. I think that's a fairly conservative target if you're fairly bullish on the stock. Still, the credit spread makes a higher profit, $502 versus $278 or $290 on the debit spread. So as you can see, the stock really needs to move quite a bit before, you see it has to move almost to 103 before these two strategies start to outperform the credit spread. So as you can see, this is really where you can see the difference between a credit spread and a debit spread. A debit spread, like buying a call or a call vertical, the stock needs to have a fairly substantial move before you get any decent returns, versus a credit spread can make a profit even if the stock stays where it is, versus the debit and credit spread requires a fairly large amount of move, almost a $3.50 move before these two strategies start to outperform the credit spread. But that's kind of where you have to ask yourself, how bullish am I on BMO? Do I think it's going to go to 103? Do I think it's going to go to 104, maybe even 105? Because if you do think that it can make a big move, and there's no reason that you can't think that. So if you think it's going to move up to 105, as you can see, that's really when this credit spread really underperforms. And that's why I say that if you're expecting a big move, don't trade a credit spread. There are far better trades to make if you're expecting a large move. So if you think it's going to move up to 105, as you can see, buying the call gives you a $1,091 profit versus only $520 profit, or a $937 profit on the call vertical. So this is really where you can use our P&L simulator to compare different strategies, and this will help you decide exactly which strategy is best suited for you, because you can use our P&L simulator to work backwards to say, okay, I think I'm fairly confident that if it moves up, it can move at least to 102. And if that's all you're confident in, trade the credit spread. But if you do think that there's the possibility that this stock can move up to 105 because you feel that the banks are oversold and you think that they are going to go back because of earnings coming up or something like that, you can use these indicators to give you an idea as far as, okay, if I do think it'll go to 105, maybe I should just buy the outright call. This is a tool that really allows you to better understand your strategies and know exactly what your potential rewards and risks is before you place in trade. Something that if you're looking at an option chain and you're trying to select a call versus a credit spread, how do you compare how they would perform if the stock goes up 3 points by using an option chain? The answer is you can't. Even if you were a professional and you knew exactly what you were doing, you'd have to make some back of the envelope estimations, and they would be estimations at best. Chances are you may not even get close enough to really be able to make a decision. That's why we created Options Play, because as traders, we needed to know exactly what our expected profit is and exactly what our expected losses are, and be able to compare different types of strategies. The option chain really only allows you to compare one call to another call. It doesn't allow you to compare a call to a credit spread or a credit spread to a debit spread. You can't do those things from an option chain. Only Options Play allows you to create any three completely separate strategies and actually compare them apples to apples, side by side, so that you can see exactly what your expected return is, so that you know exactly what to trade. And once you're ready to place that credit spread, you can click on that trade button, which will open up a portal that will show you exactly how to enter this trade into your broker's platform. So it'll tell you how to break down each leg so that you enter them properly. And lastly, we have what's called a strategy checklist just to make sure you're trading with the trend of the stock, you're trading with the trend of the market. So here I'm taking a bit of a contrarian view. So it's telling me that I'm trading against the trend of the stock and the market, but I'm okay with that as long as, but this is designed to make sure that you understand what you're trading. We're looking at the options play score to give you an idea as far as the strength of the strategy. And lastly, earnings date. We check to see if there's earnings coming up, and spread and liquidity. So now what I want to do is I want to just show you an example of a high probability. So this has a 55% probability of profit, not spectacularly high, but you can trade things that look like this. Well, actually, there are no more strikes any lower. Okay, let's look at a different expiration. Let's see if we can find some lower strikes here. Let's do this. So here, as you can see, I found a December 22nd, 88.92 put vertical. This has a 91% probability of profit. And I see a lot of people trading these types of things. But as you can see, I'm collecting a $200 reward versus a $3,000 risk. So a lot of times people, what they do is they only look at this probability number and completely avoid the fact that they're risking $3,000 to try to make $200. You know, most other times if someone said, you know, I'll give you $200, but if you lose, you have to pay me $3,000, you'd run away pretty quickly. But it seems like when options trading, people tend to just focus on the 99, 90, you know, whatever probability. Here it's a 95% probability of profit. Here I'm going to make 120, but risk $3,000. You know, that means that, you know, in this particular trade, you can lose 20 times in a row, or you can win 20 times in a row and get wiped out that one time, all your winnings in a single losing trade. Is that something that you want to do? If you're comfortable with that type of risk, go ahead. That's certainly not the type of trading that I want to be doing. I much rather try to collect something like this, where I'm risking, you know, $1,000 to, I'm making $1,000 to risk $2,000, because all I have to do is have 2 winning trades and I've overcome, you know, 1 losing trades. That's something that I'm far more comfortable with versus, you know, placing 20 winning trades and then losing it all on a single trade. That's not something that I want to do. Next example I want to give you is XIU before I open this up for Q&A. I'm looking at XYU because this certainly is a ETF in a bearish trend. I don't know that this bearish trend is necessarily over with. We certainly got a bit of a V correction here. But, you know, I still think that, as you can see, momentum indicators are a little overbought and starting to turn over a little. So I'm going to make the bet that, you know, and especially since this is right around a resistance level here, you know, 2023 or so, I'm going to make the bet that there's a possibility that this is going to roll over and continue moving lower. So I'm going to take, instead of shorting the stock, I'm going to look at selling a call vertical or a credit spread. Same thing, I'm going to look at maybe a December 7th expiration. So I'm going to look at a trade that, let's say, has a $1 wide credit. So $1 wide, I want to collect roughly a third of that, which is 33 cents. So here I'm only going to be able to get 25 cents. So maybe I'll move this to 75 cents. So here we go. A 75-cent credit wide credit spread. I'm collecting exactly a third of that, which is 25 cents. This allows me to collect $25 while risking $50. Exactly the risk reward I'm looking for. 62% probability of profit on this particular trade. So let's take a look at this. XIU's at 22.95. I think that this thing could move down to maybe 22.5, I'd say 22.5, 22.40 is probably a conservative target. So let's say I think it's going to move down to that amount. As you can see here, well, actually, before I do that, let's compare apples to apples. Let's say I'm willing to risk $500 on this trade. So I can sell 9 contracts of the call vertical. I can buy 8 contracts of the puts and 13 contracts of the put vertical. So now let's compare this side by side. So as you can see, if I think that the stock can move down a little bit to 22.40, here I'm going to collect $225 profit. Here I collect $32 profit on the put, but I collect $299 profit on the debit spread. So here immediately, even if the stock moves remotely down to even 22.40, I'm actually better off trading the debit spread than I am on the credit spread side. So this is really where I'm going to have to go back to the drawing board and say, if I'm even modestly bearish on this particular trade, the credit spread is probably not the best thing for me. I'm probably better off trading that debit spread, because because I do think that there's a possibility that they can easily go down to $22, which is where it was just last week. So if it does go down to $22, as you can see here, I'm still only going to make $225, not optimal, versus here I make $819. I'm much better off here trading this debit spread if I think that this thing can move back down to $22, which is only 90 cents away. But if I think the stock's going to stay where it is and maybe even move a little higher, maybe it'll move to $23. As you can see here, if that's the case, the picture is completely different here, right? Because now I'm still going to collect that $225, even if the stock stays exactly where it is or move even a little higher. But if I bought the put or the put spread, I'm down almost $500 here. Not optimal, right? So this is really where you can ask yourself, how bearish am I on this trade? Do I think that this thing has a possibility of really moving down? If I do, I'm clearly going to trade the put or the debit spread. But if I think it's just going to stay where it is or even move a little bit higher, I'm certainly going to trade that credit spread. So that's really where that credit spread has far more flexibility and is far more forgiving. It's just that when the stock does take a tumble, you're not going to be able to participate on that because your reward on this is limited to the credit that you receive. So that I hopefully helps illuminate a little bit of the difference between selling a credit spread and buying an outright put or a call or even the debit spread. So at this point, what I'm going to do is I'm going to open this up for Q&A. If you have any questions regarding anything I just showed you here, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for. So it looks like there's a question here from Peter. For ETFs and index options, because of low implied volatility, their premiums are much lower than those of individual stocks, and therefore the credit received will be very low. Is it worthwhile to trade credit spreads on ETFs and index options? So I certainly agree with you, and I understand what you mean. And there certainly is going to be limited ETFs in Canada versus US. We tend to find a lot more opportunity in ETFs on the US side. So in Canada, I do understand. But as you can see here in XIU, on the call, I was able to find one that meets exactly the type of criteria that I'm looking for. So if you stick to the liquid ETFs, yes. If you're trading less liquid ones, perhaps you might want to look on the individual stocks here for Canada. When we expect the stock to move sideways, which strategy is better, selling a call credit spread or a put credit spread? So that's where you can actually compare the two, right? So if you really expect the stock to go absolutely nowhere, then generally speaking, the puts will be better because the put has higher premium. But you can put the two side by side. So let's say I'm going to short a put vertical. Let's say I sell the 98.96, and then I look at a call vertical. Let's do the same thing. 100. Well, I can't exactly find one exactly with the expiration dates or the strike prices. So here we go. They don't have high enough call strikes on this one. So unfortunately, there aren't enough strikes here for me to give you an example on this, but you can compare the two side by side and see which one gives you more premium. Generally speaking, the puts will give you a higher premium for the same amount of risk versus calls. So if you really expect the two to stay if you really expect the stock to remain neutral, we generally find that the puts will give you more premium than the calls. How do you open the oscillator panel at the bottom of the chart on the middle panel of the options play screen? Great question. So you can click on the expand button on the historical chart to add individual studies. So you can just, as you can see, I have an expand button that allows you to click on studies. You can add them here. So if I want to add RSI, I can do that. And then I can remove them by clicking on the little X arrow here to remove any other indicators. Peter, you're very welcome. Adina, I hope that answered your question. And I think, Peter, that answers your same question about the momentum graph. Any other questions regarding credit spreads? If there are no other questions, I just want to thank everyone for taking the time out this afternoon. For those of you that want access to this free version of Options Play for Canadian symbols, you can go to optionsplay.com/TMX. And for those of you that are interested in trading US listed stocks, so if you're interested in using the exact same platform I just showed you for finding opportunities in the US, you can find that with a free 30-day trial and weekly educational webinars and trade ideas at optionsplay.com/income. And after the free 30-day trial, if you're interested in continuing with us on the US side, it's $50 a month or $500 a year. Is there any other questions regarding anything that we just explained here today? Oh, quite light on the questions today. Raymond, thank you so much. I really appreciate that. If there's no other questions, please, I just want to thank everyone for taking the time out this afternoon. Looks like Jennifer's got a question. How do I choose expiry date, i.e. the credit spread is better for short versus long dated? Great question. So you can click on modify here and you can just click on the expiration left or right arrow if you want to move it out one or in one. So like I said, generally speaking, you want to pick something that's less than 30 days out from expiration. So as you can see, December is 45 days out. I'd say that's a little too far out. November 30th, which is 24 days from out, that's how you choose your expiration date. You can click on modify and you can change the expiration dates just by the click of a mouse. There's another question here. For the income trade, maybe I missed a point. Are they managed by Options Play? So we do not manage the positions for you. That's why we created the slide here to help you understand how to manage your positions. You have to manage your own trades. Richard, thank you so much. I really appreciate that. Susan, thank you so much. We do these presentations for you to help you guys understand these strategies. More importantly, helping you understand how you can do your own analysis. We know that using these types of option chains is not easy to figure out where to start or figure out what your risk reward or ratio is or anything like that, or probability of profits. These are all really important things to understand before you place a trade. So we really do these to help you guys better understand the strategies, but more importantly, show you that you have tools that allow you to do your own analysis and do them well, not just estimate what your risk reward is. We want you to know exactly what your potential best case and worst case scenario is before you get into a trade, and that's when you have the highest chance of being able to stick to your trade once you're in it. You haven't discussed volatility, either historical or implied, during this session. Credit spreads are best in which volatility environments? Great question. So in theory, credit spreads are best when implied volatility is high. However, I find that that's a bit of an overgeneralization of volatility. I think people have made volatility into something that's simpler than it actually is, because certainly when implied volatility is high, that in itself is not a good time to sell credit spreads. Credit spreads are best when you expect implied volatility to decrease. Now, what can you do to know that implied volatility is going to decrease? That I couldn't tell you, because there's no indicator that I know of in the world that will tell me that implied volatility is going to decrease. So that's really why we don't talk about implied volatility. We can certainly look at how it affects our strategy. So for example here, let's go back to the BMO example. Let's select I'm bullish, and I'm going to modify this to that bullish strategy that I was looking at before. Let's see. I think it was the November 30th, 99.5, 97.5. Yep, this was the one that we're looking at. So let's take a look at how implied volatility affects this. So let's say the stock stays neutral halfway through expiration. I've made 92% return. Here's how volatility affects, it has to be before November 30th. So let's say a few days before expiration, the stock is trading near the strike price. This is how volatility affects your option pricing. So if implied volatility increases, you're going to lose money on your credit spread. If implied volatility decreases, that's how you're going to improve the returns on a credit spread. So lower implied volatility from where it is what is best case scenario for a credit spread. However, I don't know of any tools in my toolbox that will tell me whether BMO implied volatility is going to be higher or lower between now and expiration. You can make the generalization that if implied volatility right now is very, very high, that it's somewhat likely that it's going to be lower in the future. But that, in my opinion, is a very overgeneralization of volatility, and it shows that that it's not a very good understanding of volatility. That volatility, while it's mean reverting, does not mean that when it's high that it's going to get lower in the future. And that's really why I don't discuss these things as a general in general during my webinars, because also, as you can see, the volatility of BMO is at 16, right? Even if you think it's going to go down by a few percentage points, the difference between your P&L is really just down to just a few dollars. As you can see here, the difference between 17 and 15 is a matter of $5 profit. And that's why I don't really talk about implied volatility, because a change from 17 to 15 is a pretty big change in implied volatility, but it only equates to a $5 profit or gain in this particular position, which is nothing compared to if the stock was to go up by even a couple of dollars. As you can see here, it's a $24 gain versus a move down to 99 is a difference of almost $50 or so, or $40 or so. So a $1 difference in the stock equates to a $40 profit versus a huge, massive decrease in implied volatility is only about a $5 loss. That's why I don't like to use volatility here in these particular discussions, because the overall impact to your P&L is fairly minimal compared to the directional exposure that you have. And that's why we determine whether you should buy a debit spread or a credit spread based on your directional view, not on your volatility assumptions. Nor do I think that just because something has high volatility, should you assume that volatility is going to decrease over the lifetime of that option. So I know that was a very, very long-winded answer, and I'm actually quite passionate about this and why I avoid talking about volatility. And it's really because I feel that it's doing a disservice by saying that, oh, you should sell credit spreads when volatility is high and you should buy debit spreads when volatility is low, because delta is far bigger exposure to your P&L than volatility will ever become in your trading. So make sure that you remember that. And the next time someone tells you to sell credit spreads just because volatility is high, think to yourself first, what directional view do I have on this underlying stock? Because if I think the stock can move even a little bit higher than as you can see, than 102.5, clearly the debit spread here is better. So this is just a mild view on the underlying stock. The stock going from 99 to 102, I should trade the call versus the credit spread. Even if volatility is going to decrease by half. So this goes from 17 to 8, which is unheard of. As you can see, the impact of volatility on my overall strategy goes from $99.56 down to $53.64. The impact of that is minimal compared to if the stock moved even a dollar higher. As you can see, this moved from what? 102 was $53 to $150. So notice how minimal the impact of volatility has on your trading strategy versus a small delta change has a substantial amount of change in your trading. So focus on delta, focus on direction. Don't put too much effort into volatility. Great. I really hope that I answered that question. I know that was a very long-winded answer. Any other questions? If there are no other questions, I just, again, thank everyone for taking the time out this afternoon. The webinar is recorded, and I'll be sending out the recording in about a half an hour, so look out for that. It'll include the slides for those of you that want to follow along or take a look at some of those links in those slides that I send out. So please have a great afternoon, and I will see you guys in a few weeks. Thank you so much.